Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So this video is the next installment in our Guru Investor series where I pick one of my favorite investors and go through my top 3 lessons that I've learned from that particular person and apply to my own investing today. So in this video, this was a fairly popular request in the comment section on previous Guru Investor videos, and that is Peter Lynch, the author of this book, One Up on Wall Street. So if you don't know who Peter Lynch is, he is one of the most successful mutual fund managers of all time. He through the 80s was managing the Fidelity Magellan Fund, returned about 29% per year compounded over his tenure sort of managing that particular fund. So he's a bit more of kind of a growthier style investor than a lot of the people that I follow, but that makes his perspective even more interesting. It's nice to have a lot of those sort of competing ideas up in your head to try and figure out what's sort of the best strategy for you. So with all that said, let's get into my top 3 lessons from Peter Lynch. So my number 1 lesson from Peter Lynch is that small investors have a key advantage over large institutional investors, more specifically with finding new businesses that are sort of on the rise. So if you're not familiar, many institutional investors have a lot of quite strict rules in terms of how they allocate their money in their portfolio to different types of businesses. And one of the key restrictions that they often have is that they can't invest in really small companies. They often have to have sort of a minimum requirement in terms of maybe the market cap of that company or the daily trading volume, so that they know they can get in and out with large amounts of money without too much trouble. And that really opens up the doors for small investors to really focus on smaller, less well-known companies. So Peter Lynch gives the example of individual investors going out and seeing some sort of new franchise that maybe starts up locally in their area. Perhaps it's in the early days of something like Dunkin' Donuts, which was a very, very successful investment for Peter Lynch. For a long period of time, Dunkin' Donuts was a public company, but for a long stretch of time, it wasn't really that well known by institutions because it was initially trading in a very sort of localized, small area as it was kind of getting its feet on the ground before it expanded into this massive franchise that we know today. So if you come across situations like that, particularly with new businesses, it really does pay to check oftentimes the sort of ownership structure of the company, particularly if you're a keen investor looking to find these newer, really profitable companies. I'm not talking about investing in startups that don't make any money and that don't have long growth trajectories or anything like that. I'm talking about companies that have successful small scale economics. They make a lot of money from maybe their 1 or 2 or 3 stores that they already have, and they have a long runway for growth out into the future. So that's by far and away my number 1 lesson from Peter Lynch, is to look for these small businesses that really aren't that closely followed by institutions. It makes the opportunity set much greater than just focusing on the big companies, and it also creates a lot of opportunity for you to get in and understand those companies before a lot of other really smart people do that and just jack the price right up. So my second major investment lesson from Peter Lynch, and this is going to be me kind of merging a few here just because I struggled a little bit to kind of keep it down to 3 lessons from Peter Lynch. But the second one is a combination of kind of 2 things that I learned from Peter Lynch, which is 1, don't worry what the market is doing. Even thinking for 2 seconds about whether you think the market is going to go up or down or sideways doesn't matter. And the second kind of part of that is that the thing that really drives returns in terms of a change in stock price over time is earnings. Earnings is what drives a stock price to go from $1 a share to $10 to $100 a share. That just doesn't happen magically because of no particular reason. Typically that happens because you've got a high quality business that has grown its earnings over time. Peter Lynch often uses the example of someone like Walmart. If you bought Walmart when they first IPO'd and looked several years later when they had 10x or 20x, you will also have seen that their earnings had grown by about the same amount. They were earning about 10 or 20 times as much money. If you fast forward a little bit further, when they were 50 or 100x, then their earnings had grown by 50 or 100x versus when they first IPO'd. So one of the core learnings I had from Peter Lynch is to focus very, very strongly on earnings growth and where the trajectory of earnings is likely to go into the future. And really what the market does in that time isn't going to have a huge influence on the returns that you might get out of a business like Walmart or like a Dunkin' Donuts if you can pick that up really early and the business continues to grow even through poor markets or recessions or whatever it is. And this is a lesson I think a lot of people have learned from Peter Lynch, and I just want to spend a couple of seconds kind of putting it in context, because I think a lot of people do fall into this trap of just buying growth and buying regardless of price, not paying much attention to the price. They just look at a business that has a long runway for really fast growth and they think that investing in that is going to work out really well, and oftentimes, frankly, it does. But you still have to pay attention to price. And I think a lot of people picture Peter Lynch as this really sort of growth-oriented investor. He's just investing in high-growth companies that can be much bigger in 10 years than they are today. But Peter Lynch actually does pay attention to price. And he goes through some fairly simple ways of thinking about this. One of the classics that I picked up from a book that I still sort of use as a useful proxy, and Phil Town has something kind of similar, is that he talks about this relationship between a growth rate and a PE ratio, just a really simple way of trying to understand with just basic surface level numbers, is this company likely to be overvalued or undervalued? And it obviously requires a bit more kind of deep thought than that, and I have several videos on valuation and things on the channel. But Peter Lynch talks about this relationship between PE and growth rate, and he for a long time had the target of trying to buy these high quality growing companies for a PE basically equivalent to 1 times the growth rate. So if he could find an early Dunkin' Donuts that was growing at 15% a year, he would aim to try and buy that business for a PE of 15. Now, if we put that in the context of today's stock market, that sounds obscene. You look at companies like Apple, for example, that are growing at 5 to 10% a year maybe, and they're now trading at like 40 times earnings. They weren't all that long ago, but now they are today. There's many businesses, something like Chipotle comes to mind, which is trading, I think, at 80, maybe even well north of 100 times earnings at this point. So you do still have to pay attention to price, but fundamentally, regardless of what the market does, earnings growth is going to be a massive driver of returns in terms of stock price appreciation over a period of time, really regardless of whether the market's up, down, or sideways. Now, my third, and certainly not my final, but I'm trying to keep these videos down to just 3 lessons from Peter Lynch, is actually a chapter in this book, and I want to kind of read through just a couple of them. And basically, this chapter is all about the 12 silliest and arguably most dangerous things that people sometimes say about stock prices. There's some really common ones in here, and this book is several decades old at this point, and many of these still apply today. There's still a lot of these concepts that are just as understood as they were when Peter wrote this book. But I want to share a couple of them, give you my perspective, and just an example of some of the things that you can expect to see if you haven't read this book before, which if you haven't, I highly recommend it. So the first one that we've got is, if it's gone down this much already, it can't go much lower. And I think this is a classic example of what we saw with something like the airline businesses, for example, earlier this year. So, we saw many of the airline stocks down a huge percentage earlier in the year. Even at those low prices, people like Warren Buffett were selling out. Because he frankly believed that the intrinsic value of those airline businesses had dropped even more than the price suggested. And you had all these people, a lot of them newer investors that were using, stimulus money and all this sort of stuff to go out and invest, and they saw the stock price that was down 50 or 60 or 70% or whatever it was, and thinking, I must be getting a 50 or 60 or 70% discount to what this is actually worth. And, if it goes back anywhere near that, I'll make really good returns. And that is sometimes true. Sometimes businesses do get mispriced, and that's frankly what I'm looking for all the time. But it's not as simple as just looking at a stock chart. When in the airline example, they, number one, are taking on a lot of debt. Number two, their cash flows are not likely to be as good over the next probably 2 to 5 years, frankly, as they were last year or the year before. And overall, that, strong negative cash flows over the next few years and the existing debt that they've already got gives you a high risk of bankruptcy. And that debt also has to be repaid out of earnings over a period of time. You can't just go and rack up credit card debt and expect that to have no impact on your net worth over time. That credit card debt does have to be repaid back, out of your future wage earnings or salary or whatever it is over a period of time. And that's exactly the same for the airline companies. Now, the next one of these 12 silly things that people say about stocks is it's only $3 a share, what can I lose? And this is a classic kind of beginner era, basically looking at the share price. Maybe you're looking at a company that's trading at $10 a share, and then you compare that against like Amazon that's trading at maybe $3,000 a share, and you say, whoa, Amazon is way more expensive than the $10 share. And that doesn't mean anything, frankly. So the way you should be analyzing stocks and analyzing businesses, which is exactly what a stock is, it's a piece of ownership in a business, is looking at the value of the overall business. If you think about a company as a pizza and shares as pieces of that pizza, whether that pizza is just cut in half and you have 2 massive pieces, or whether it's cut into 8 different slices, if you combine all the pieces, you still have one whole pizza. It doesn't matter how many slices it's chopped up into. So the fact that something is $3 a share doesn't necessarily mean that that particular business is expensive or cheap or anything like that. It's simply just a result of the number of shares outstanding relative to the overall value of the business. Now, there's plenty more gems in this chapter, but I'm just going to share one final one, which again, I think is a bit of a beginner era, maybe again a bit more intermediate, I don't know. And that basically goes that a stock is up, so I must be right, or a stock is down, so I must be wrong. And this is a classic, kind of beginner era, I guess, in investing. Basically looking at the stock price in terms of helping you to justify assess a particular investment decision, particularly in the short term. Over the long term, we know that markets price businesses in and around their intrinsic value. So over the long term, this is certainly going to have more weight. If you've held a stock for 20 years and it hasn't gone anywhere, it was probably a bad investment. And if you've held a stock for 20 years and it has, 30x or something, it was probably a great investment. But looking over a shorter period of time at just stock prices and trying to figure out, whether that was a good or bad decision, is not what you should be focusing on. Really, you should be focused on number one, the business returns. We just spoke about how earnings are a massive driver for stock price appreciation over the long term. And if the business fundamentally is performing really, really well and growing as you expect, and you got it at an attractive price, then the price going down in the short term is not a bad thing at all. In fact, it opens the gates for you to lower your average price. And if you do have a high level of conviction on that business and you think you're right about the future trajectory, that can set you up to improve your returns even further. And by the same token, if a stock goes up, it doesn't necessarily mean you're right. If we go back again to the airline example, you can see that after Buffett sold out at a much lower price than he purchased those stocks at, they shot up, and you had all these Robinhood traders, telling him he's an idiot and that they're better investors than him and all this stuff. And really, you have to focus on the business results and look at, where those airlines are going to be in 5 years' time. What are their earnings going to have, gotten back to? How much debt did they have to accumulate through this really tough period? And then you can start to understand, based on the business results, was that a good investment or not? And over the following 5 years after that, it's likely that the stock, will at some point get priced in and around its intrinsic value, and you can really help to, figure out whether that was a good investment or not. So those are a few of my top lessons from Peter Lynch. I do hope you enjoyed the video. If there's anyone else you'd like to see in this series, definitely let me know down in the comments below. But that's all from me today. So please hit like and hit subscribe if you did enjoy the video, and I will see you in the next one. Cheers.